Markets have clearly recovered from the April lows, but there's no shortage of uncertainty for investors. Joining us now with more, Brad Simpson, Chief Wealth Strategist with TD Wealth. Interesting times we've been through just in the past couple of months, Brad. What a spring we've had. There's a current, I guess, macro setup that you're looking at. And, okay, you're going to have to explain. I don't like the sound of this. You say, looking like 2022. I didn't like 2022. What are we talking about here?
Yeah, it's actually a good segue in there, though, is right, that unless we're talking about tariffs and potential impact, which will kind of lead into to this segment, is, you're Jack Daniels, and you can see the impact rate there. I mean, that is.
I'm just not going to. I'm not going to have that in my house as much as off.
There's your cleanest snapshot of the direct of what the potential impact and it looks like. So I thought that was an interesting one of the ones that we were looking at. If you reverse back into 2022, an awful lot of the soft data that was coming out was, like consumer was concerned, and inflation was still a high concern. Looking and a call saying as you'd move through 2023 that you're going to start to see a higher potential of a recession, and that sentiment was there, and as we moved through 2022 and then into 2023, a recession didn't happen. Sentiment changed dramatically, and so instead of an inevitable recession, really we led to was here we are a few years later, still no recession. A lot of growth in financial assets around the world, and I think that if you look at even we just went through a reporting season, like companies were trying to give guidance and saying, we're looking out now. They were less pessimistic at the end of the quarter that we just went through. But all of that, I think there's some interesting similarities that we can kind of consider and look at it, then as we moved on, and here we are sitting in 2025, and we've had some pretty big ups and downs, but all in all, they've been pretty darn positive. And so I think the second part of that is of course that ultimately we came to the conclusion is, let's just buy big tech, right? Like that's, and so I brought a chart along I thought would give a little bit of context that I wanted to today, and also help me to frame this. Let's go to one. I've got one. It's called "Fear is Out and Greed is Back."
Fear is out and greed is back. Let's see if we can pull up fear. There it is.
Because I think that's a really good start of this, and that is what's changed, and really what we're looking at here is. I think last time I was here, we were in the middle of the April correction.
We were fearing things.
We were full on fear. And really all we're showing here is that over the last, let's call it 5 weeks since the last time you and I got together, there's more positivity around the about tax cuts and the extension of those, the tariff negotiations with the U.S. As the market between China and the U.S. are more positive on that. And earnings have either met or been better than what's expected, and this is a market that trades on one headline at a time. And I think the point that I'm really trying to hit home here is that this is a market that all of a sudden is that fear is so yesterday. And let's start moving and let's start moving. But if we're going to move, and it's going to be more difficult, of course, it's a lot of what has driven this market return has been piling back into that tech story again.
How do you stay calm if you're moving on a headline at a time? Because there's no every time I look, there's another headline that you say, "What am I supposed to make of that?"
I get that, and I think that. I think there's a couple things that we have to do, and it's a little bit like we were talking about the Section 899 again. Is that what you and I have witnessed in our lifetime, and we've talked about this before. But what's happened with the news cycle is that the rate it comes out of that fire hose is multiplied unbelievably. I'm still startled at how quickly, if I look up anything, if it's on, if I go to Instagram and look at something for more than a couple seconds, I get all of a sudden, like I ride a road bike. Anything I look at a road bike, my goodness, if I stop for a minute and go, that's that's a beautiful bike.
That's all your phone is showing you.
All of a sudden, I mean, it's bikes and bikes and bikes and bikes. And of course, this time of year is usually the time when a guy wants to buy a bicycle. And I think my point with all of this is that we have to kind of pull ourselves back a little bit and say, is that, in an environment that we're living today and we're thinking about how we're going to invest, let's look at this text thing a bit. And I think that was the one that we put
the
up.
AI chart?
Yeah, let's look at AI, right? Because really a lot of this, again, has been, first of all, that the tech companies that have reported really good earnings, and so the market is kind of everybody stuffed back into this again. But if we extend out our time horizon a little bit and we think things out here a little bit, what we're looking at here is we said, okay, here's the performance of the Mag 7 stock. So you can see that big bump that we've had since April and the run kind of helping drive everything. Looking at the equal weight index of the S&P 500. So that's not looking at market cap weight. So it's not being driven by the returns of these big tech companies. And the black one is what we call downstream AI beneficiaries, okay? These are like companies like Costco, companies like Walmart, like Marsh McLennan, healthcare companies, the ones that are ultimately going to be the beneficiaries of this. And so I look at this, and if I said to it, when I look at this, what I see is going, okay, so the top orange line, the Mag 7, is the hope part. It's the getting, but it's also getting into the semis. It's getting into the direct beneficiaries, the hardware, the software providers. They're getting in the Microsofts and getting into that, right? The next one is the infrastructure, the engineering, the commodity side of it. The next one is the long-term one. It's the other ones in the rest of the sectors. So when somebody says, well, gee, how do I invest in an environment like this one? Because it's expensive. The S&P 500, 22 times earnings or somewhere along those lines. I go back and go, let's back up a little bit and go that over the next 1 to 5 years, that black line, which is we're seeing the companies across sectors are going to be the ones that are going to be the beneficiaries, they haven't gone to the moon. That's tomorrow. Yeah. And there, I think, is that it's so incredibly important. Like having a time horizon, a medium to long-term time horizon for investors has become a cliche, right? Yeah. It's not a cliche. That moving in and out of Mag 7 or growthy names since April like that, or since this turn because on a headline and the concerns of April are all behind us and now we're there. That's akin to it's a speculation. Yeah. And I'm not here to knock speculation, right? But what I am to say is that there's a difference between speculation. My background is in quantitative investment management, right? One of the main factors is momentum. I mean, a lot of what trading we now see is momentum and momentum trading. There's a big difference between momentum trading and how I'm going to invest. And so I think the big part of this, before we even get to the asset allocation part of this, is I look at something like this and think, okay, even to the point of what's my concern about Big Beautiful Bill Act and Section 899, is that those that black line on the bottom, those are all growth companies. For the most part, they're going to have lower dividends, and they're going to be the type of companies that are going to be the beneficiaries of AI as they start to kick in. And the switch is going to happen is that what inevitably will happen is that the orange line, the MAG, will come down and they'll revert to the mean. The black line will, 5 years from now, will be where the top line is today. And that, I think, is that if you'd extend out your time horizon and get back to ultimately its earnings per share growth and it's getting it down the road, there's all kinds of places where you can invest today in an environment like this one.